Hello, good morning, students. Good morning, all of you. Today, we are going to talk about marginal costing. Now, for marginal costing is a technique of measurement of cost. So, we are aware that marginal means additional, where in economics we used to calculate marginal costing like current total cost minus previous total cost. So simply marginal costing is nothing but distinction between variable cost and fixed cost. In marginal costing, we consider only variable cost. Now I would like to draw your attention towards my format of marginal costing, that is we can say income statement of marginal costing. Now you can see that we have to take sales, and from sales we have to subtract variable cost. Once we subtract variable cost from sales, we get contribution, and after getting contribution, we have to subtract our fixed cost, then we will be getting our finally profit. So what is variable cost means? Variable cost is a cost that is going to be changed or that changes according to the level of output. But your fixed cost is not going to change with the level of output. It's going to remain the same. Now, what is the meaning of contribution? After subtracting variable cost from sales, we get contribution. Contribution is nothing but it is the R saving before subtracting fixed cost. Now, I would like to explain you some formula on the basis of variable cost contribution in sales. First one is a PV ratio. For PV ratio, we use formula contribution upon sales into 100. Sometimes there is a possibility that in a problem we cannot use this formula. They might give us two different periods and we will have to calculate PV ratio. We will be given only sales amount and profit amount. So here we can use the formula changes in profit upon changes in sales into 100. So that is the way to calculate PV ratio. Now second thing which we need to prepare, or we might have to calculate break even points. Break even point is a situation where there is a no profit, no loss. It means our income is equal to our expenditure. So what is the formula for break even point? Fixed cost upon PV ratio into 100. It is clear from the given example that we cannot calculate break even point unless and until we calculate our PV ratio. Now, if you want to calculate break-even points in units, you can use the formula fixed cost upon contribution per unit. It means when you divide amount with the rate, you will be getting your break-even point in units. Now, second formula we have to use for margin of safety cell. Margin of safety cell means what? After recovering our all expenditure, whatever we are going to get profit, that is called break margin of safety sales. For margin of safety sales, we have to use the formula actual sales minus break even point sales, which we have already calculated. Or we can use the second formula for margin of safety sales, profit upon PV ratio into 100. So I hope all of you have got information regarding how to calculate marginal costing. Okay, thanks. We'll be meeting in the next lecture.